Hello, my name is Anton. As I was introduced, a partner of ChainSecurity, and I guess our panel today is proposed build versus general purpose chains for stablecoin adoption. Yeah, maybe we can start with current situation, an overlook of what we have. Like, what's your point? Like, first, a small intro from you, Alex and Stuti, and what's you consider current status of adoption of stablecoins? What chains are dominant in your opinion?
Hi, everybody. I'm Alex. I am the founding general partner at Verda Ventures, where we focus on stablecoin infrastructure. Before I fully answer your question, want to give it to Stuti to do an intro, and then we can kick it off.
Yeah, sounds great. So I'm Stuti. I'm a partner at Triton Capital. We were formerly known as Kraken Ventures. And our thesis is that blockchain is better infrastructure for financial services. So we invest quite a bit in the space of everything talked about today.
So to go to your question, which chains are dominant? We actually think that over the next 5 years, there's going to be an increase in fungibilization of blockchains. And basically meaning that stable coins issued by the likes of Tether or Circle will find it easier to go between blockchains. And that basically means that value, in our view, will likely flow up the stack towards application-facing users, towards the user-facing applications. So we actually think that a lot of the dominance will come at the stablecoin issuer level rather than just at a particular blockchain. But that fungibilization, we believe, is going to make the infrastructure layer relatively less important.
We also have Bogdan joining us, so maybe Bogdan.
Yeah, I was late for dramatic effect. Hi everyone, sorry I'm late. Cabify is better than Uber. I'm saying this publicly on record now that I had a problem. Bogdan, one of the co-founders and CTO at Tenderly. If you're a DeFi developer, you're probably using Tenderly for development or for infrastructure products. That's the TLDR. I don't want to derail the conversation. Please continue. I'm going to jump in.
Yeah, actually, I would say maybe we do a bit step back and go back to definitions. Like, how would you define general purpose versus purpose built chains? Like, what's the actual difference? Like, we know mainnet Ethereum and hopefully it's general purpose, right? But can you have examples or opinion about what's purpose built chains?
Yeah, so general purpose chains, you kind of covered this already. I think what they're meant for is for multiple kinds of applications, right? And so stable coins on general purpose chains are tenants there. You know, they're not necessarily meant to be the main star. But on purpose-built chains, stable coins are also the operating system. So that's kind of how I think about the difference between the role of stable coins on general purpose chains versus purpose-built chains. But as an extension to this, I think sometimes people think about Tron as like a stablecoin chain, but it was actually never built to be a stablecoin chain. It eventually evolved into that. So I think there's still a gray area, and it's not necessarily black and white, because also some chains tend to find product market fit with certain products, certain applications.
Bogdan, Alex?
Yeah. I have the same view from a different lens. So the way that we at Tenderly at least look at this stuff, we look at it like as ecosystem chains versus app chains. And then we look at stable coins as an application chain type thing. Now, when you think about it, it is what you want to incentivize the block space to be used for. In a generalized chain, the BlackRock transaction that is buying like a warplane shares the same block space as me buying like a CryptoKitty or whatever. Now, in my head, that doesn't make sense for anything high frequency payments that's needed, but for important stuff, it does make sense. For application-specific chains, we are talking about usually are most people going to use the block space for transfers, etc. But a lot of people, and what we're seeing now more and more, are starting to write pre-compiles or actually change the execution environment for it to be better for stablecoin payments. A good example is Arc from Circle, where they will have private transactions as part of the runtime itself. So it is going to be EVM compatible, but it is going to have this change where the transactions can be private, because one of their assumptions is for enterprise payments, you need confidentiality, not just public transactions existing there. So this is how I view it. If you're changing the runtime, or most of your block space, or like the state is going to stablecoin transfers, this would be like the stablecoin specific chain. Everything else, I would argue, is an ecosystem chain. And then finally, a feisty comment. I don't know if we're going to cover later. I think that we're going to end up with like 5 to 10 ecosystem chains only, but thousands of app chains. I think there isn't a space for 100 Arbitrums bases optimisms, but there is a space for thousands of these general purpose chains for specific stuff.
I think the future is likely to be some hybrid combination of general purpose chains plus application or stablecoin focused chains. And the reason is, even if you have your own permission stablecoin chain like Circle's ARC, you don't get the benefits of composability or liquidity that you would find on an Ethereum. At the same time, institutions, for compliance reasons, do require this permissioned layer, which you're only going to get by having your own specific chain and controlling the entire stack, which is part of the reason Circle is creating a chain like ARC. At the same time, ARC in a silo doesn't fully capture the value of blockchain. It doesn't capture the composability and interoperability with DeFi. It doesn't capture the liquidity network effects. So our view is that there will be a hybrid interaction between these stablecoin specific blockchains or application specific blockchains, as well as general purpose chains such as Ethereum.
Yeah. I don't think there's actually a all-weather answer to whether stablecoin activity is going to be on general purpose chains versus purpose-built chains. The pendulum tends to swing based on whether it's a bear market or a bull market. Whenever we are in a bull market, we become this all L1 multi-chain world. And when we are in a bear market, DeFi attention and liquidity tends to re-aggregate to Ethereum and maybe now Solana or 1-2 other L1s. I think that this pendulum will swing. At first, as I said, it's like Ethereum, and then in the bear market, and then the all L1s, the blue chips in the bull market. And then it'll become like maybe Ethereum and a few more L1s. And then in the following bull market, you might also have some of these app chains specific to stable coins. And this will tend to vary across multiple cycles, but I think it's always going to be based off of where we are in the cycle.
Yeah, that's very insightful. Maybe I want to develop a bit on Bogdan's kind of features of purpose-based chains, right? He mentions like there is an ARC that has private transactions. Any other you see features that purpose-built chains can do better than general purpose that would help with stablecoin adoption?
Stable prices. When I say stable prices, I mean stable gas prices, like as in each transaction will cost the same. That is a thing that in our world, I think we became completely okay paying anywhere from a single cent to $75 for Uniswap swap to pass. That's one. But when you look at it for other stuff, it's like if you're in the Cosmos ecosystem, IBC is a given, which is a pre-compile on the EVM variants of Cosmos chains, where the superpower is you can move assets around actually, not like lock it in some place, unlock it on another one. From talking to networks, so the ARCs, Tempos of the world, etc., so far what we're seeing, it's mostly the confidential transactions. My assumption is it's because of regulatory pressures why this is happening, and the fee stuff. So technically you can guarantee if I'm transacting USDC, it's always going to cost like this, and that's it. So it's always going to be a fraction of a cent or like 1 cent, and that's it. Other than that, we still haven't seen any innovation specifically. You could argue, given enough time, that you can do a native swap as a precompile, that you could do a native perpdex as a precompile. I don't see why people would do that, to be honest. But it is still generic code that you can ship. But so far, it's like consistency, as in price consistency, and then the second one is confidentiality. This is the two things that we see so far.
Anything to add?
More tangential point is that for small transactions, I think the transaction fees will be negligible. So it'll be a fraction of a penny on a base or a Celo or another layer 2. And then for larger transactions, if you're transferring $1 million, you don't mind paying $1 or $2 on Ethereum mainnet for the incremental security. So we see a sort of bifurcation happening depending on the value at risk. And we don't see it as strictly necessary to have a fixed fee in order to facilitate transactions.
Yeah, so I look at this a bit more big picture. So what do users actually care about when they're going to interact with the blockchain? I think there's 4 highlights. The first is credibility, then efficiency, then cost, and then finally utility. So credibility is the Lindy of a chain. How acceptable is the brand? Reliability of the chain. Efficiency is the performance. So, the speed, for example, finality, settlement times, etc. Cost is fees. And then utility is distribution and liquidity. So when we're looking at general purpose chains, I believe that they tend to excel in offering good credibility as well as good utility. And then the promise of purpose-built chains is better efficiency and performance, as well as better cost. I think that this latter thesis has yet to be proven and shown out in multiple cycles and also specifically at scale. But I believe that these are the promises. And as a VC, when I am evaluating just L1s or L2s as opposed to purpose-built ones, these are some of the factors that I'm looking at.
Thank you. Maybe it's a bit of a question, like we now see a lot of traction with each stablecoin makes their own chain, so to say. Like there is a Tempo from Stripe, right? There is a Arc and what's not, right? So the question is, like, do we really need that many chains? Is it part of this stablecoin war where you really need to have your own chain to get an upper hand over the competitor?
I mean, I think it's just economic self-interest. They don't want to pay rent to another blockchain. And if you're Stripe, you have the built-in distribution. So if I were them, I'd probably do the same thing. It's like, I'm already bringing my own distribution, which by the way, covers like 5% of world GDP in terms of process volume. I don't know if it's exactly that, but it's on that order of magnitude. And so by controlling the whole stack, they get all of the fees instead of needing to pay a base or another blockchain for those transaction fees. And then they can, if you do want to leave their ecosystem, there will be some kind of interoperability protocol or standard that can leave, but that'll be a far fewer transactions. So in other words, by having an interoperability standard, they can get the benefits of shared liquidity and infrastructure, but most of the transactions will happen through their distribution channel, and by having their own chain, they can capture value at each and every level. So to me, it's economically logical and self-interested that they would go pursue this path.
Thank you.
I agree. You told me that I cannot use a specific sentence to explain this phenomenon, but I know a lot of people on X were like, why is Stripe doing this? It doesn't make any sense. It makes complete sense. Business-wise, technologically, maybe not. I mean, even technologically with the changes they're doing, but business-wise, it makes complete sense. And I mean, your question was also like the verticalization of these like stablecoin issuers and then them launching a network. You also have for Tether, by the way, you have both Plasma and Stable, which is interesting that there's even 2 attempts, more or less. An interesting way that I started looking at this since a few days ago, actually, is the stablecoin isn't a rail, where in my head stablecoins were rails. It is an asset. This might be apparent to anyone. It was very much not apparent to me 2 days ago, because where do you get the value? A good analogy that I started thinking about is in the US, my Eastern European mind cannot comprehend this, but in the US, you have a credit card for Macy's. This makes no sense to me, but this is a thing. Does it make sense for Macy's to have their own chain or for their own stablecoin? Because if you pay at Macy's with your wallet, or the third variant would be them having their own wallet, which is like, I think, the worst one of the 3. But when you think about it, if Macy's would like to do a point system where you get like cashback, or United wants to give you miles for using a credit card, if we live in a future where credit cards die, which I hope really they will, it makes sense for them to have a stablecoin, not to have a chain. And then they're going to pick Stripe, Sark, or Base, or whoever. Base is doing a huge push for them to be this destination chain. But also when you look at Stripe bought Bridge, so I would assume that this is what they're trying to do with these stablecoin issuance for multiple companies. I think that for the next year or two, the meta is going to be chain plus stable. And then some chains, the rails themselves will die out because the routes are inefficient, because there's no liquidity, as you mentioned, or it's not performant, as you mentioned, etc. But we're going to be left with much more stable coins, which I think will have a place in this world.
Yeah, in the general purpose chain world, stable coins are tenants in a shopping mall. So anytime somebody wants to come use them, they have to deal with the existing Westfield infrastructure, the parking lots, the buildings, the traffic in and out of the mall, right? And there's definitely pros and cons to that especially relate to distribution, liquidity, credibility. But then in the other world where they decide to be a standalone shop, they now have to be able to bootstrap liquidity on their own. And I think that part is hard, but it's not the most difficult part. A lot of these stablecoin companies right now, they are financial companies with technology features. Once you become an L1, or an L2 even, you have to become a technology company. Now they have to deal with uptime. They have to deal with nodes, node infrastructure, core developer communities, cryptography. And this is a very, very different beast than just being a stablecoin issuer. So, if you have the cash, if you have the balance sheet to be able to fund an experiment like this, I think it's worth it for the upside, but not everybody does. And that's understandable as well.
So I think to Bogdan's point, there is a potential for, like with Bridge and Stripe, this sort of shared infrastructure where you kind of white label the infrastructure, and then the end brand, Macy's in this analogy, can just basically leverage whatever infrastructure's there. Sort of like credit cards as a service where you don't do any of the infra, you just put your brand on it, and then all of the back end is taken care of. I think that's a potential outcome, especially with the distribution of Stripe and Bridge. So that's a good point.
Yeah, maybe then a bit like to disagree a bit with Bogdan to start it. You told like that consumers want dollars, right? Like assets, and not really like asset of stable coin issuer, right? Maybe to disagree with that, it's like quite often these issuers have very different risk profiles, and they have very different like people who trust them, right? So is it something you think will actually affect like distribution of liquidity and then the usability of the chains?
I think depending on which time scale we are talking about, short to midterm, I agree with you completely. People care about this. Long-term, the Serbian dinar has been pegged to the euro at 118, and the whole country is scared if we get the correct FX ratio, it's going to be 230, and we're going to have a civil war. So in that sense, people just trust what you tell them. So in that sense, like long-term, I think like normal people aren't going to care. I think we're a hyper-financialized ecosystem, and we are aware of those things. So short to midterm, yes, I'm not going to take Macy's points if they're on if they're on a bad chain. It's similar to I wouldn't transact on the chain. To me, it was interesting. Like I saw a pattern where I wouldn't transact 3 years ago. I wouldn't transact on the chain unless it had an Etherscan instance, because like Etherscan was social proof. I'm not going to get rugged. Very dumb way of thinking, but this is how my brain worked. I think it's similar thing here. We're going to we're going to see if 4 tokens from Bridge or through 4 stablecoins from Bridge end up being bad. None of us are going to use Bridge enabled or Bridge powered tokens or stablecoins. But I think in the long term, people don't particularly care.
I think credibility is a very important topic. You're not going to get fired, as somebody working at a corporation for launching a stablecoin or a product on Ethereum. I think that there's a better chance that you're going to be under fire if you launch on some emerging L1 right? Or maybe even build your own chain and it ends up getting hacked, as an alternative. So credibility matters a lot for a chain, and in crypto, like Lindy is somehow a measure of unhacked TVL, and the ability for a chain to just survive over, at this point, like something like 5 to 10 years or 3 to 10 years. And that matters.
To add on that point, I don't think most L1s today can justify being an L1 instead of being an L2, because Ethereum offers better security, better decentralization, and better tooling than any other L1. So I think most L1s that exist today would be better off being an L2. Also, as Stuti mentioned, because of the credibility factor. If you have the security of Ethereum, that's going to give you a lot of wind in your sails. So I would, my hot take is that most L1s today will fail.
Another thing is, I think there's a lot of chat around Tempo and Stripe, also having amazing distribution, and becoming, one of the maybe de facto payment chains moving forward. But if you are a fintech that is interested in crypto, I doubt that you're going to want to launch what you're building on Tempo. So there is still very much still an opportunity for a more neutral chain, such as an Ethereum, or maybe even something else, to be the go-to place for stablecoins if you're in the fintech or even like TradFi space and looking to launch or interact with stables. So I don't think that any of these emerging stable chains have really won the race, and specifically not the ones that have their own branded stablecoin that is aligned to the distribution of a specific tech company or financial services company.
It's going to be a bloodbath for years, I think, but yeah.
Yeah. We have Momo joining us. Momo, I guess you can do a quick intro of yourself.
Yeah, for sure. Hi, my name is Momo. I'm one of the co-founders here at Codex. Codex is an Ethereum-aligned stablecoin chain. I heard this topic is quite pertinent for this conversation. Previously, I was a product manager at Facebook, and I've been a stablecoin and crypto enthusiast since 2017. Having invested in various protocols to the likes of Athena, Agora, and back in the day, Basecoin, and some of these more exploratory ones as well.
Thank you, Momo. And I guess since you're joining us, a question for you in the spirit of what we already discussed, but it's actually what you just mentioned from the panel, stablecoin adoption. When we say that it happens for like purpose-built chains, where you see it coming from? Is it as Bogdan told, like private individuals going to use it just to like try to protect from inflation and to facilitate payments between like peer-to-peers, or it's also institutions who are interested in those?
Sorry, I want to make sure I get your question. So your question is, who is using these stablecoin focused chains? Is that right?
I think it's this moment is more about who you're seeing in future will be using them, because at the moment it's...
Yeah, so stablecoin proliferation has been up and to the right over the last couple of years. But if you zoom out and take things in perspective, right, the set of all B2C payments and B2B payments across the world is still much, much larger, right? Penetration of stablecoins today is at the low single digits, if you take that into consideration. So, the answer is I think over time, stablecoin is going to be the de facto technology by which money moves in a lot of use cases. The proliferation is going to take years, if not decades, to come. And who wins, and whether there's one or few or many protocols and networks on which these stablecoins move. I think this is still up for grabs, right? This is why, I've built Codex. Yeah.
Anybody wants to add on that? Or?
Who's going to use it in the future?
Yes.
Companies. We at Tenderly use it. We have two entities. Serbian and US entity, we settle in stablecoins between them. Not always, but we accept payments from some of the customers we support in stables. We always pick to settle payments between the entities in stables if possible, because it's cheaper. Plus, we don't have to wait like 750 days for the bank to process the thing.
Yeah, I pay, and across my businesses, I pay everybody in stablecoins. But I would say like most of them all want to be paid on Ethereum or Tron. So I haven't gotten any inbound demand saying I need to be paid on a non-Ethereum or non-Tron. So we'll see if that changes. But my general view is that a lot of these, like, unless they have pre-built-in distribution. So if you're a Stripe, I think, honestly, you could do whatever you want. You already have your distribution and you'll do well. But if you don't have your own distribution, I think there's a high chance that it's going to be difficult to get that distribution if you're trying to build a permissioned blockchain. I'm biased because Tether is one of our LPs, but I think like USDT, in which it's sort of a more permissionless type activity, will likely be one of the winners. Because if you think about a lot of the actors receiving and sending money, maybe they're afraid of their government, maybe they're afraid that you're a Russian citizen and the U.S. government decides to freeze your assets by working with the chain owner. I think Tether will likely be one of the big winners as things shake out. And I think the permissioned stablecoin only blockchains that do not have their own distribution channel will find it very difficult to get distribution and scale.
What are your thoughts on Plasma and Stable?
So so Tether actually, like, they just put in a very small amount. To be honest, I'm not sure if that's public information or not, but they play up Tether's role, but actually the check they put in is like very small. I think from Tether's perspective, it's like, let's just put some money and see how it goes. It's like if heads it win, like I win, tails I don't lose, because it's so like immaterial for them. But I think it's likely going to be the case that there will be fewer rather than more blockchains in the future that win. Yeah.
And to Bogdan's question, who will be the users of these stablecoins and these stablecoin chains potentially? It's going to be everybody eventually. I believe the market size for stablecoins is that of currency itself, so over $80 trillion. Right now, we are at a few hundred billion at issuance. And I don't think that there's anybody that is a winner in that long run when you think about that barely scratching the surface of what the true stablecoin market size can be. And I also don't think that there will necessarily be one or two or three winners. I believe that there's an opportunity for stablecoins to serve different types of people and different purposes. Personally, us, we've invested in quite a few stablecoins. I'll give some examples. We invested in CAP, Money. We invested in Athena. We invested in Agora, and a handful of others. And we don't believe that we have portfolio conflict. We think that one person, say in Latin America, could be holding one stable and transacting on one chain for payments, something else for risk-adjusted yield, something else for maybe higher risk yield, right? And so the market has yet to be won, and I think there's going to be many winners and many forms that takes.
So this is very interesting. And like, for example, DeFi is like a use case where you think it to follow to the purpose-built chains, or do you have problems with fractured liquidity, and cross-chain liquidity problems? So is there's going to be enough liquidity on these purpose-built chains to facilitate good enough DeFi for the users?
You go first, Alex.
Okay, so as I mentioned earlier, I think there will be an increase in interoperability between blockchains so that there will be permissioned capital that can basically interact with permissionless DeFi on, for example, Ethereum, where Aave has the most liquidity by far on Ethereum. So that's kind of the longer term vision that I see, is you have increased fungibility and interoperability between layer 2s, but also layer 1s, and that they'll be able to basically leverage the infrastructure and liquidity and elsewhere, and most likely, in my opinion, Ethereum will continue to have the deepest liquidity. So that's kind of our worldview and mental framework.
I think technologically we're going to figure out pulling liquidity from everywhere. I know 1inch had one of the announcements where you don't need to, they announced it like 3 days ago. You don't need to put money somewhere. They can just permissionlessly pull money. It's like proof of, I can't remember, but it's like technically proof that they can pull the money if needed. The question there is, will we have APRs as high as now, if that's the case? Because if you can move money everywhere across all of the chains, you need competition for APRs to be high. Like the reason why traditional banks give lower percentage yield, it's not because they're assholes, it's because they cannot generate more. I mean, part of it is that they're assholes as well, but they cannot get more yield from this stuff because it's lower risk things here. And the arbitrage opportunity itself is the risk, at least how I always perceived it in DeFi. So I don't know if that answered your question, but I think it's solvable. I'm not scared about fragmented liquidity from a technological standpoint, but financially, I have no idea if it makes sense.
That's good, thank you. Anyone who wants to rent? Otherwise, we have like little time left. And I guess I would like a future prediction round, so to say. So right now, de facto, you have most of TVL. I mean, I would say not most of the volume of the tokens on the Ethereum mainnet, right? So like it's TVL. If you see by stablecoins minted, it's still dominated by Ethereum. Actually, if we consider Tron also general purpose chain, even the volume can be seen as dominated by general purpose chains. So on scope of, let's say, 2 years, where you think will be TVL and volume? How will be the TVL and volume distribution between general purpose and purpose build chains?
Like I said earlier, if you're moving $1 billion, you don't mind if it's a little slower and it costs you $2 on Ethereum rather than 1 cent on an L2. And for that reason, we think the larger liquidity will continue to be sticky on Ethereum because if you're moving $10, like, okay, you're sensitive to a 1 cent transaction fee, but if you're moving billions, like that's just not a concern for you. Security is number one.
So just ballpark, you say just TVL gonna be mainnet, as I get it?
I think at least 70% of TVL will stay on Ethereum mainnet, and that other chains will likely be optimizing for lower transaction fees and faster throughput.
Yeah, Stuti?
If we are in a bull market, then stablecoin liquidity and attention is going to aggregate towards Ethereum. And if we're in a and as well as other chains, and if we're in a bear market, then it's going to be Ethereum.
True.
Bogdan?
Depending on Stripe is a public company, and them making this bet is not a small thing. I would argue that there's going to be a bunch of TVL from all of the major banks that they are connected with on their chain. So I would argue that I agree with you that most of the liquidity will be on Ethereum, but I think they're going to eat a bunch of liquidity as well from the chains where some of that liquidity is right now. So I think they're going to aim for the neck for the like chains. I don't know the leaderboard, but chains like 7 to 15 are not going to exist when it comes to TVL.
Momo?
Yeah, I think most of the liquidity will stay on Ethereum, but I think, for example, for a lot of flow use cases like payments, there's chains out there like ours and a couple others that are purpose-built for specific use cases and have features like, for example, if you're moving money, right, to specific corridors, there's always a risk when you touch fiat banking rails that there's like an RFI, right, like a request for information where the money gets stuck. We are building features where you can proactively see whether there will be an RFI ahead of actually sending those funds. What is the value prop for the end business? It means that the incidence of money getting stuck via crypto transfers on the fiat rails is much lower because we can basically proactively mitigate that, right? So these are features and iteration, like these types of features are going to take much longer to build and implement on like the general purpose chains than on, for example, RL2. So what we see this playing out is most of the liquidity and where the money will stay will be on Ethereum, but where it moves and like how it moves, those new use cases where payments are now moving from fiat to crypto will be more and more on specific purpose-built chains, and we're already seeing that playing out. Yeah.
Yes, thank you. Yeah, we.
What's your thought? What's your thought? Quickly, 10 seconds. You didn't say your thought. 2 years from now, TVL. What's your thought?
Yeah, let's do it again. We need to see how good we predicted that. Yeah, we're out of time. Yeah, I just have some. Thank you everybody for participating on the panel, and I guess if you want, please meet us afterwards.
Thank you.